Hi, I'm Ross from Lifetime Property Accountant, and I just want to go through a simple example of allocating a shareholder salary and what is an overdrawn current account and what's the issues with it. So I'm just going to share my screen and hopefully go through a relatively simple example. Most taxpayers hate the subject and don't understand the subject. Hopefully this makes it easy and simple. So we've got the year ending 31st of March 25, which is just finished. Yeah, most taxpayers, we're doing financial statements for that. You've got a total company profit of 130,000. It's the first year of business. We are looking at normally what would happen is we'd most likely pay the whole 130,000 out as a shareholder salary to the person who is working and doing that. This example is slightly different. We've had a client query, what happens if we do a shareholder salary of 80,000 and we retain 50,000 within the company? So if we allocated a higher salary, if we allocated the extra 50,000 to the individual, their tax rate, they're already earning 80,000, they're already using up the lower tax rates. After 80,000, they're up to 33%. So if we give them another 50,000 salary, they're going to be taxed at 33%, 16,500. If we retain it in the company, it's going to be taxed at 28%. So the tax rate is going to be lower. So the appealing part of this and why the client's querying is they're going, oh, that's saving me 2,500 in tax if I leave the profit in the company and pay 28% instead of the 33%. The big problem is the 28% is only an interim tax. So sooner or later, that extra profit, that extra 50,000 has to go out to the shareholder as a dividend, and it has to move out to them at their tax rate. That might be 33%, or if their income's gone up, that might be 39%. So they might even pay further tax. But with this example, this is the first year. Let's say they've taken all the money. So they've earned 130,000. They've taken the whole 130,000. So what happens from a tax point of view is they have what's called an overdrawn shareholders current account. So this is something that comes up all the time. It's quite a common term. Accountants love it. Accountants understand it. Taxpayers don't. But basically, what's happened is if we did this situation, 130,000 profit, only allocated 80,000, but the person's taken the shareholder's taken all the 130, they've taken 50,000 that belongs to the company. It's been retained by the company. So they've taken more than they should have. They've got an overdrawn current account off $50,000. That $50,000 we have to charge, or the company under tax rules has to charge interest on it if it's a normal standard company, which it would be if you're doing a shareholder salary. The IRD rate that they set is around about 10%. So in a year, the company is going to have to charge you $5,000 because you've got an overdrawn current account. It won't be for the whole year because some at the start of the year it's going to be zero. At the end of the year it's going to be 50,000. It's going to balance out. So maybe let's say it's going to be $3,000. So effectively, what happens is the company needs to return that as interest. The 50,000 profit is going to go up by $3,000 interest on overdrawn current account. The company is actually going to pay tax on 53,000. It's going to pay $14,840. So if we're comparing that to what we had before, we're paying an extra $840 straight away. So the two, it was $2,500 difference, but now it's less. So once you actually do it, account for the interest on overdrawn current account, you're actually going to have not such a big tax benefit. And still, that 50,000 is still going to have to come out to the shareholder at some point. They're probably still going to have to declare the 33 or 39, so they're still going to pay the extra tax. So that's the first year. So if we look at the shareholder's current account, opening is zero, plus the shareholder salary of 80,000, less the drawings that they've taken out, the full amount, the full 130,000, plus we've got interest on overdrawn current account, off another $3,000. So what happens at the end of the first financial year? They've started off with zero, got the shareholder salary of 80,000, less $3,000 overdrawn interest on overdrawn current account, less 130,000 drawings. They're overdrawn 53,000. So that's the first sort of year. So if you'd kept it in the company, you would have paid lower tax. You would have paid 14,840 compared with the 16,500. But then this then rolls into the next year. So the next year, say they do the same, 130,000, shareholder salary 80,000, retain 50,000 in the company. Their opening shareholders current account, they're 53,000 overdrawn, plus the 80,000 shareholders salary, less the drawings they've taken out. They've taken out the whole 130,000. So we are now up to an overdrawn current account of 103,000. We are looking at doing interest on that similar to last year. Got to charge interest at 10%, around about 10,000. The same, it won't be for the whole year. So let's go $8,000. What we've then got is, overdrawn current account is getting bigger and bigger. We are now looking at 111,000. We would also have to pay extra tax on this 8,000. So our initial situation, we were looking at, just change that formula slightly. Oops. We were initially looking at paying 16,500 of tax versus the 14,000. Well, unfortunately, that 14,000 is not right anymore. It's gone up. It's going to be the original 50,000 plus 58,000. So we're now going to be paying tax on 58,000 at 28%. We're now up to 16,240. So you can see that the tax benefit is getting worse and worse. And what would happen is if we went another year, the interest on the overdrawn current account would get worse and worse. The interest on the overdrawn current account would get higher and higher and higher. This figure would get worse. We would end up paying more tax at the 28% than we were just getting out at the 33%. But then we've still got the big issue. So our big issue, we've got to get the dividend out. So if we did a dividend now, we've retained companies' profits. We retained 53,000 last year, which was our 50,000 plus the 3,000 interest. We've retained 50 this year plus 8. So what happens is we have retained profits. I'll do before tax, so it's easier. So we've got the 50,000 from last year, plus the 3,000 interest, plus the 50,000 from this year, plus the 8,000 interest. We've got 111,000. If we now did a dividend to the shareholder, they are earning 80,000, so they're going to both get $100,000 off that salary. That is going to be at 33%. So they're going to pay 33,000. Less the 28% that they've already paid. So 28,000, we're obviously going to have to pay some extra tax on that. There's an extra 5,000 in there. Then they are going to earn 11,000 of that at 39%, because with the $100,000 dividend and the 80,000 salary, they're now up to 180. So any further profits is going to be at 39%, less the 28% again that they've already paid. So what's going to happen is we're going to have some extra tax. That is going to be that minus that, plus that minus that. So we're going to pay 6,000 extra tax. So what's happening overall with this whole thing? Initially, we were looking at a situation where you're hoping to reduce tax by doing 28% 33, but you've had to pay $840 extra in the first year interest on overdrawn current account. The second year, there's further extra. There's 2,240 of extra tax on the interest. So there's getting a little benefit. Then if you got out all the earnings come out to the shareholder, you're going to then pay an extra 6,000 tax. Some of that's at 39%. overall, you've actually paid more tax than you would have to start with. So rather than just paying the tax at 33%, getting it all out to the shareholder, not having to do dividends, not having to do interest on overdrawn current accounts, yeah, you would have actually paid less tax than having to do dividends, which are going to cost you through an accountant, having to do the interest on overdrawn current account and paying that extra tax every year, and then still getting it out. And because you've got it all out in 1 year, it's pushed you into the 39%. You've then paid some extra tax, 11% more than what you're hoping. So yeah, overall, just lots of problems, lots of issues with getting an overdrawn current account. It's complicated for tax, means we have to charge interest. So yeah, generally be very careful if the 28% is the interim tax. It sounds good, but it's got yeah, it comes back and bites you in the future. It is going to mean that you're going to have more and more tax in the future. Hopefully that's been helpful. Thanks a lot. Bye.